Hi, everyone, and happy Monday. I want to welcome you to our second session of Intro to Venture Investing with 1000 Angels. My name is Erica Dagnan Minahan. I am founder and CEO of 1000 Angels, and I'm so thrilled to get to spend the next half an hour with you guys chatting a little bit about some of the things that you might want to know as an early stage investor, as well as to explain some of the thought process that we use here at 1000 Angels on building a portfolio, as well as specific investment selection. So, as I said, my name is Erica. I actually have been doing early stage venture investing for the last 12 years. And prior to that, spent about 8 years in public market finance doing investment banking. We're based in New York City, here in Manhattan. So looking forward to connecting with everybody and getting to know you better. The other thing that I just want to remind all of the participants is that there is a Q&A feature on the Zoom webinar. So if you have questions, specific questions that you'd like to get answered, feel free to use the Q&A box to interrupt me at any time with specific questions around the material that we're covering. All right, so let's get started. I am going to share my screen. Okay. There we go. Okay, so now you guys can see the slides. So we ended session one right around here, maybe a couple slides in. So we'll just sort of stop at this midpoint and continue on covering maybe one or two slides that we covered previously very briefly. So in the previous session, we did speak in depth about this slide, which is, all the reasons why you should start venture investing, looking at some of the risks and the potential rewards. So, I think that just to recap what we talked about, really the biggest risk here, or the biggest challenge with early stage venture investing and why it can be, a little bit difficult to stomach for some investors is just that, there is basically very little liquidity, and there's also really very little predictability around the time horizon of the investment. So, when you make an investment in one of these companies, you could get your money back a year later, you could get your money back 5 years later, you get your money back 10 years later. So it's really kind of completely outside of your control. So that's one of, what I would say is probably the biggest risk to venture investing. But, there are, of course, many really fantastic rewards beyond the fact that, a well-constructed early stage portfolio should expect to have at least a 25% IRR. That's annual returns of 25%, but also compounding because you're not allowed to take the money out, so you don't have to worry about that. But beyond that, there are a lot of other rewards in that you're able to more clearly direct your capital towards building certain products and services in the market, which a lot of investors really find empowering. And then given that the companies are much earlier stage, I believe there is a much higher level of transparency around exactly what they're doing and exactly what the money is being used for, versus when you buy a stock in a behemoth company, you never know what they're doing, right? Like, let's take, the Facebook example. I'm sure there are a lot of people who purchased Facebook stock who, may not be so thrilled with some of the negative externalities that ended up coming out of the Facebook company over the last few years. So with a very early stage venture, there's a little bit of a clearer sense of exactly what you're putting your money to work to do. And you have a greater ability to really understand who the founders are and to support people that you think have, a vision that's aligned with something that, you think is really a positive contribution to the world. So, those are some of the really fantastic things. And then one thing that's not on the slide that I would like to mention, which I think is actually really kind of a overlooked and not really talked about benefit, and that is, of course, the tax advantages. So the PATH Act, which was passed a few years ago, I think in 2013 or 14, added a small provision which greatly affects the taxability of your gains from any investments in the types of companies that you might see on 1,000 Angels or early stage startups. So if you're investing in the equity of a C corporation in the US that has less than $50 million in assets, and pretty much about every company that you'll see on our platform has fewer than, starts off with less than $50 million in assets. And you hold that investment for at least 5 years. And given that, the expected holding period is 5 to 10 years, it's very likely that that will happen. You are allowed to basically take all of those capital gains completely tax-free. So there is no capital gains on the tax up to the greater of 10 million or 10 times your investment. So since very few of you are probably planning on investing $1 million into any particular investment, basically you get up to $10 million in capital gains completely tax-free. So from a tax-adjusted perspective, that also really sort of reduces the risk on the expected return of the investment, because, on the companies that you do have gains for, the gains are sort of juiced versus what gains you might have from a public market investment or a later stage investment where those gains are actually taxable. So we went over this slide last time. It just sort of gives you a sense of the fact that, when we're doing seed stage investing, we are really all the way out there, pretty much on the risk spectrum. I mean, I guess the only thing that would be, riskier would be probably, certain options, unhedged option strategies. But as far as, non-derivative assets, seed stage investing is obviously the highest risk, but it's also the highest return. So what are some of the ways that we can reduce this risk that's inherent when we want to invest in this asset class and get those high returns? Well, there are a few different ways. Number one, and the most important, is diversification. So, as you add securities to your portfolio, you actually reduce the overall risk of performance because, now there's a better chance that there's one really, top performing company in your portfolio because basically, what we're looking at is, the sigma, sort of the standard deviation of returns on the asset class is very large, right? So the more single investments that we get into a portfolio, the better overall expected risk-adjusted return to your portfolio. And this is really important for this particular asset class because, as we said, the standard deviation of returns is, much larger than it would be for, say, blue chip stock investing. So what we're trying to do is to make sure that as we develop a portfolio that, those companies that end up being home runs, that we're actually getting, maybe sort of 20% of our portfolio ends up being those companies that do exceptionally well, and they basically provide that high, above market rate return for our entire portfolio. Great. So the next thing that you can do to really reduce risk is co-investing. And so with co-investing, what we're essentially doing is we're allowing, we're basically making sure that as we make a decision around whether or not an investment or a company is viable, we're making sure that we're getting some sort of really vetted outside opinions on whether or not this is something that's smart to do. And I would say that, the number one way that people lose money on investments, but for some reason it seems to be a really, really common pitfall, is that they basically don't kind of get a second opinion, right? So somebody comes to them with an investment opportunity and they just, jump into it without, sort of asking somebody else, trying to find somebody who's maybe an experienced investor to take a look at it or to see, is anybody else coming into this round? So co-investing is a great way to use sort of, the wisdom of groups, at least, not necessarily the crowd, but the wisdom of groups to help you make better decisions. The other reason that co-investing can reduce the overall risk of each investment is that, instead of, it just sort of being you and the founder and, maybe a couple other friends and family, now the founder actually has, other people with a vested interest in the success of the business that are, financially invested in the success of the business. So, that gives them access to more resources, more people that are willing to help, more people that are interested in protecting their investment by helping to build the value of the company. So that can really be, something that's really critical. So whenever we're looking at an investment opportunity, we're also very seriously considering who else is investing in the company and, how much capital they have. As well, kind of as what we call dry powder to help support the growth of the company in the future. An ideal situation is one in which, you maybe have like a larger fund that also invests in more growth stage companies that's willing to come in as a seed stage investor because that, once that company starts growing very quickly, they're going to have very easy access to much larger checks of the size of which, you as an individual investor probably won't be able to manage. So, let's say a company is doing a round of like $1 to $3 million right now, but if they're very successful, they're going to then need to raise 10 million, then 25 million, then 50 million, whatever it might be. If you're co-investing with funds that actually have, that capital available to write those bigger checks when needed, it just sort of de-risks the entire opportunity significantly. The third thing is, of course, due diligence. And, people sort of want to know, well, what is due diligence? We talk a little bit about this during this webinar, but basically due diligence is actually going in, looking at the financial model, doing an analysis of the market opportunity and the size of the market opportunity, really sort of looking at the competitors, really understanding how the business model works. And really the most important thing here is, understanding why the underlying economics of this business makes sense. And that's something that, unfortunately, a lot of investors will skip over doing. I've actually seen several times, companies that have the ability to raise, hundreds of thousands of dollars, particularly, from maybe West Coast investors who are less concerned about this sort of stuff, but they've never even done a financial model. And, they can't, sort of confidently say, how they think they might make money and how, they're actually able to create value. So, one of the big things that we look for at 1000 Angels is we look for, a really well thought out financial model, a company that understands its cost of customer acquisition, understands, its customer lifetime value, understands, basically how they're going to get their product into market and retain customers. And then beyond that, really sort of understanding, okay, what are all of the sort of external competitive forces that might affect the ability of this company to succeed. So we really consider that an important part of our diligence process, as well as just really getting to know the founders. So, at the seed stage, a big part of diligence is, who you're investing in, right? So, can you trust these guys? Do they have, sort of the run through walls type of character that's actually needed to make a startup successful? And, one of the things that I think is so important for people to realize is that, actually making a startup successful takes a tremendous amount of emotional grit and perseverance. And because of this, it actually requires a certain personality type that, can hear no 1,000 times and kind of, not be phased, right? So we get to know our founders really, really well because at this stage, where they haven't kind of proven that, they can get to a place where they're ready to scale, we need to know that, whatever challenges come their way, they're going to be able to get through that. So it's another huge part of diligence. But we'll go through the overall due diligence process a little bit more in depth in future sessions. And then, some of the other things you can do, of course, engagement. So engagement means that, when the founder sends out an email saying, hey, we need introductions to such and such, and so, and we need this, and can anybody help us with this, that you just pay attention and you participate and that you support as well as you can. Engagement does not mean emailing the founder once a week to ask how things are going, but being really responsive to their needs and providing assistance where you can. So, if you feel that you can be helpful to a startup and the founder is welcoming of that once you've made an investment, being an engaged investor is a great way to add value. Another thing that, a lot of people don't realize, especially for a company that's growing, is that, one of the big challenges, biggest challenge actually, I think, in execution is hiring a great team. So if you know that, the company that you invested in is, trying to fill 10 roles and they're looking for really fantastic people to, leverage your network, obviously you're probably a successful, great person who knows other really great, successful people, so that's one of the great ways you can be engaged and help out. So with human resources, with, introductions to potential clients or, suppliers, those types of things are great ways to be engaged and support the growth of the startup you've invested in. And then, of course, just good record keeping. So, that's one of the things that we do for our investors on 1,000 Angels is we basically will keep a database of all of the documents that you've signed digitally and, have them sort of in a portfolio. So, when you set up a Schwab account and you start buying stocks, obviously there is something online where you can actually see your investments and, be able to track them. And so we essentially create on 1,000 Angels that same type of portfolio tracker for you so that you can remember everything that you've invested in, how much you invested in it, what was the cost basis, and actually see, have those documents sort of saved to your portfolio tracker for you so you can access them when the time comes, right? When a note needs to be converted or, there's an exit opportunity, you just sort of want to check what was in the original agreement. You'll have quick access to all of those things. But, even not through 1,000 Angels, good record keeping is a great way to make sure that you're sort of paying attention to everything that's going on in your portfolio, since, a lot of these investments kind of do have a set it and forget it type of mentality from the terms of the fact that, from the time you invest to the time that, there's some next opportunity for liquidity or action, it could be years. So this is a good way to make sure that you stay on top of your investments. So how does diversification work, right? And why does it work? Well, and we're sort of going through these elements of risk reduction one by one. So, basically to get into it a little bit more, a single investment is a very big gamble, right? And so when we talk about diversification, we're really kind of looking at least 10, the goal is probably at least 20 investments over time. And depending on what your budget is, this will really kind of guide, how many investments that you could make. But I'd say that, probably for a very standard person who joins 1,000 Angels, let's say you're going to maybe make, 4 or 5 investments per year, right? So over time, you'll easily get to that 20 portfolio of 20 stage. Now, I just want to reiterate that over time, it does not need to happen overnight. And, you want to be really careful and add companies very selectively. Don't ever sort of have this fear of missing out type of thing. On our platform, every opportunity is attractive. Like, it wouldn't get on our platform if it wasn't attractive. But at the same time, there's no need to, get your entire portfolio of 20 investments over the course of 12 months, right? So, you have time to develop them. The other thing that we're really kind of doing here is, we're essentially purchasing what I describe as, a cheap option. So when you come into the seed round and you're, maybe investing $20,000 in somebody's, $1 million seed round, there, is an eventual kind of outcome, right? And these numbers here on this slide, I think were from research that Professor Wiltbanks did a few years ago. Yes, Robert Wiltbank did this in 2007. Actually, it's been quite a while. But my guess is that the distribution of returns probably hasn't changed a ton. But essentially, you're going to have, about a quarter of the companies that actually do really well and generate positive return. Probably about, a third or so that will, sort of get to break even, and, maybe a little bit more of that end up being a total loss. So 30 to 40% total loss, 30 to 40% break even, and 20 to 30% that actually have a positive return. So the break even ones are actually really, really important, because just getting your money back, actually just helps the overall performance of your portfolio. One of the things that, we've been really helpful to our clients with on 1000 Angels is basically just keeping you out of that total loss area. So it's very easy for people to end up in that total loss area because they invest in companies that, they haven't really done great diligence on. They don't know the founder that well. They don't have great co-investors. So, our job is really to make sure that you don't have any of those in your portfolio. And, we have pretty much never had a company, at least so far on 1000 Angels, that's actually gone out of business. So, we're trying to make sure that no matter what happens, you're at least going to be in the breaking even section. And that will, help make sure that your overall portfolio IRR stays, closer to that target 25%. And then we're going to have the other, sort of 20% to 30% that are actually in that positive return territory. And when we make an investment, what we're looking for is usually, if it's at the very early stage, we're looking for at least sort of 30x. As the companies get closer to kind of a Series A type valuation, it gets to be more a 10x return. So, that's basically what we're looking for our portfolio to comprise. So when we come in very early and invest, say, $20,000 in a company, what happens is, that company is either going to, kind of do okay, but not do great. And, hopefully is going to sort of stay in that break even mode. And then you really won't have to invest any more money in it. That's kind of, one way. Or the company is actually going to really start taking off. And then at that point, you will actually have the opportunity to invest in subsequent rounds. So, let's say you came into the seed round with a $25,000 investment, and, they're doing great, and now they're doing a Series A, and so you want to put in another 25,000, and then, let's say they raise a Series B and you want to put in 50,000. So now, you've basically hitched your wagon to a company, that's kind of hitting the hockey stick growth, and you're able to take advantage of reinvestment in a company that you know is growing really quickly and that is on its way to liquidity. So that's really the way that we want to strategize, right? We want to say, okay, we make small investments in many companies. We hope that, the ones that don't end up with hockey stick growth, at least they're going to get me to break even. And hey, it's not a huge deal because I haven't invested that much money in them. And then the ones that are doing really well, we'll be able to invest in those subsequent rounds. So those subsequent rounds are where, 90% of the value to investors is actually created, right? That's why, people, top performing VCs make so much money, is because a huge amount of the value creation from an investment actually happens sort of between a Series A and the company going public. So you want to kind of be in maybe that Series A, Series B round where there's still an opportunity that between your investment and the company being acquired or the company going public, that you can get, 10, 20, 50, even more X return on your investment. And this is clearly very different from buying something in the public market. Even when, typically, unless you like happen to buy Apple or Facebook or, some of these stocks that, have grown super fast. But typically when you're buying a stock in the public market, you're not necessarily getting you're not expecting multiple, X returns on your investment, right? You're kind of expecting market rate of return, maybe 10% annually if you do really well with, a sort of faster growing tech stock. But basically coming in these private rounds where, there's a liquidity premium on the capital, you're able to generate much higher than market expected returns. Great. So let's just talk a little bit about the portfolio approach and why it's important, right? So what is a portfolio? Portfolio approach just means allocating your investment capital amongst a larger number of investments rather than investing large amounts into just a few companies. And I know that, maybe this seems obvious, but from people that I've actually worked with, this is like one of the things that I don't know why people are just so drawn to do this. For me, it seems absolutely insane, but I suppose that's because like I did my undergrad degree in economics and my, MBA in finance. So I just have this like, this is like second nature to me. But, I will very frequently speak with people and they're like, oh, I just invested, $100,000 into one company. That's still kind of, in a riskier position. And it's like, well, why, right? Or they're like, oh, I invested 500,000 in this one company. It's just sort of like as an individual, unless the company is really kind of at growth stage, it doesn't necessarily make a ton of sense to, make concentrated bets on single companies, right? So what we want to do is we want to, invest sort of more reasonable amounts into a larger number of companies. And then once that company gets to, a growth stage round, say a Series B or Series C, then, it totally makes sense to, cut larger checks, right? If that's something that you want to do. But when we're at the beginning, we want to basically develop a portfolio so that we can optimize for risk. So if I had, $100,000 a year to invest, I'd be better off putting that into 4 or 5 companies than to, be making 2 large $50,000 investments. So, it's just sort of a scientifically proven fact that each additional investment, right, that you add to your portfolio improves the overall risk return profile of your portfolio startup investments. Now, that's assuming that all of them, kind of have been diligenced and have, sort of equal risk adjusted returns. It doesn't make sense to add something to your portfolio if like it's just a crazy, not great investment, like, oh, don't just give money to whoever because, oh, well, each additional one, improves my risk adjusted return. Each additional one will improve your expected return, assuming that they all kind of have an equal risk adjusted return. So, it's really important to sort of think, for that variable as well. And so this graph basically kind of shows you how as you add the number of equity positions to your portfolio, the overall risk actually goes down significantly. And that's what we call, the asystemic risk versus, just kind of like the overall market risk, right? So the risk of each individual company's performance sort of gets mitigated away, and you're just left with what we would describe as the market risk. So here is a spreadsheet that shows potential return outcomes on 3 diversified portfolios, right? So we're going to look at a situation where, people have sort of, these 3 different investors have chosen different approaches for, how to invest their money. So, investor A, maybe is a little bit more concentrated and ends up with, 40% of his investments in companies that end up with a total loss, 40% of his investments in companies that end up break even. He gets one that is a double, right, which is fine, but not great. That's basically just compensating for you probably for the time value of money, right? So it would be like a 15% IRR, which is good, but it's still far below our 25% hurdle rate. And then he has one really great exit, right? A 10x. So, I'm sure somebody who actually had this portfolio would be kind of like bragging all over town that they got a 10x return on one investment. But if we look at the overall portfolio return, it's only 10%. So not terrible, right? Probably equivalent to what you would have done in the market, but what we're trying to do here is actually outperform the market, right? So, the way that we can get closer to doing that is choosing a bit more of a diversified strategy. So person B, and this is why diversification is so important, is because you got to make sure that you have basically that, fifth row company, the home run in your portfolio, right? We just need to make sure that it got in there. So even with person B, assuming that they had, 40% of the companies end up in a total loss, right? Which is what, we sort of saw with the Wilt Bank study. They had 30%, this is slightly different because it's over 11, actually no, it's still over 10 companies, right? So 30% as a total lot, as a break even. And then one of the companies is a double, but then two of the companies that he's invested in actually got to 10x. And so we can see that with just one company sort of moving from the break even to being, a high performer, we've now actually doubled our IRR on the entire portfolio. Right. So from 10 to 20%. So making sure that you're getting those companies that actually are providing like the great exit into your portfolio is really critical to overall performance of the portfolio. So that's why we need to diversify, because we want to make sure that, we didn't miss that one that was a great exit. And so person C, ends up with 40% as a total loss, 30% as break even. But because, he diversified a little bit more, right, invested in a larger number of companies, ends up with one that's a double, one that's, the great exit of 10x, and then one that's actually, what we call home run, right, is a 20x. And so we can see that, almost increases the IRR by 3 times to close to 30%, 29% IRR. So basically, what this chart kind of shows is that you don't really know which ones are going to, get you the double, get you the great exit, or get you the home run. So what we kind of want to do is make sure that we have a little bit of an interest in a larger number of companies to be exposed to a greater number of potential outcomes, because it can really make a very meaningful difference in the overall performance of your portfolio, as we can see here. So when we talk about multiples versus IRR, I think that this chart is really important for people to take a look at, even people who've kind of worked in finance for a really long time. This isn't math that kind of just like stays in our heads, right? So it's good to take a look at this chart so you can get a sense of really what the cost of capital needs to be in order for you to achieve your expected outcome. So when we're at the seed stage, and we're looking for, a company to provide, that possible 20x return, if it's probably going to take longer, right? Let's say that, we're looking at expecting, an exit of somewhere between 7 and 10 years. Really, if we're asking for 20x over the next, 7 to 10 years, that's somewhere between kind of a 35 and 50% IRR on our investment. Now, a 35 to 50% annual cost of capital seems so high, but the reason that we need to sort of demand these very high numbers is because, we do have so many instances, right? We know that it's possible that 80% of the portfolio might be somewhat evenly distributed between a total loss and a break even. So we kind of need those companies that are actually going to do well to provide a lot higher rate of return in order to compensate for the companies that don't really end up getting anywhere. So the one slide that I would kind of like highlight in here, that I think really demonstrates this is that, let's say you're investing, at a Series A stage and you want to get a 10x return on your investment. If you're assuming the life of the investment horizon to be about 5 years, that IRR is actually 58%. So, it's just really understanding that, in this asset class, we're not, looking to get, 10% annual returns, right? Like the actual returns that you need to require on your capital are closer to, 50 to 60%. And that seems really high, but I think that, you guys should really respect founders from the fact that they can, take this money on and hopefully promise that they're going to give you these kind of returns. So this is another just sort of caveat around what makes something investable versus not investable. So, you really have to sort of think about the risk of whatever business is being executed. But basically, if that founder can't figure out a way to, and that's why when we invest in startups, they kind of need to be growing at least, 100% year over year. They're usually growing a little bit faster because the cost of the capital alone is, 50 to 60% at the early stage. Now, as the company gets into more growth stage, the cost of the capital goes down a bit. But at the very early stage, this capital is very expensive. And so the important thing to remember is that you, as an early stage investor, need to make sure that your investment can generate these level of returns. Otherwise, you won't be an early stage investor for very long because you'll always be losing money and you'll say, forget it. So as investors, we also have a responsibility to make sure that our portfolios are well constructed and that they generate positive return, right? This isn't a charity. And that way, we have gains that we can now reinvest into other startups. So it's part of keeping the startup financial ecosystem healthy and well functioning. And so taking the time to watch this webinar and participate in webinars like this is actually really, really valuable to our entire economy because, as an early stage investor, you're an absolutely crucial part of keeping our innovation economy functioning and thriving. So I just want to thank everybody so much who participated today. We're out of time. You guys were a little bit light on questions, but if you have a question about any of the material that we went over, feel free to drop it in the comments section. I'm happy to respond to comments, or you can email me directly. It's erica@1000angels.com. I'd love for you to like and subscribe. And if you're interested in possibly joining 1000 Angels, if you're an accredited investor and you think that this might be something that would be a useful way for you to build your portfolio, send me an email and we'll set up a one-on-one meeting to discuss membership. And if you're a founder who's looking to raise money for your startup, I'd also love to talk to you. You can email me your deck and a small little elevator pitch, also at Erica, ERICA, at 1000angels.com. Thanks for joining and have a great day, everybody. See you next time. Bye.